Let me welcome you to the Canada Revenue Agency's webinar on the disbursement quota. Thank you for taking the time to join us today. My name is Danielle, and I'll be your host for today's talk. By the end of today's presentation, you will be able to define the disbursement quota, also known as the DQ, and its purpose, determine how to calculate DQ amounts and how to report DQ amounts properly in Form T3010, Schedule 8, understand accumulation of property, as well as DQ excesses and shortfalls. Throughout the presentation, we'll be going over some examples. You should note that these examples are fictitious and used only to illustrate the concepts we're discussing. So, what is the DQ? Under the Income Tax Act, the DQ is the minimum amount a registered charity is required to spend each year on either or both its own charitable activities and/or qualifying disbursements through gifts to qualified donees or grants to non-qualified donees. You can look up subsection 149.1 sub 1 in the Income Tax Act if you want to read the exact definition. Before we get into calculating the DQ, let's go over its purposes and benefits. Let's start with its purpose. It ensures public benefit. All organizations that want to be registered as a charity under the Act must ensure that their purposes are directed to the public benefit. It encourages charitable spending, ensures that registered charities devote a portion of their resources to charitable activities, and prevents organizations from accumulating excessive capital without benefiting the community. And it maintains fairness, ensures larger charities contribute consistently to social causes instead of accumulating investment assets without conducting charitable activities. It also has a series of benefits. It keeps charities active, ensures organizations keep their charitable programs running and not stagnant. It builds public trust. Donors feel reassured knowing their contributions are going toward meaningful work. It supports communities, guarantees funds are reaching the people and causes that need them. It encourages financial responsibility, ensures charities plan their finances wisely, and avoid excessive accumulation of assets that don't serve their mission. And it promotes transparency. By completing their annual returns, which include their DQ amounts and disbursements, charities show how their funds are being used. So when does the DQ apply? There are a few considerations, and we'll go through them using this flowchart. First, are you a charitable organization or a public or private foundation? If you're a charitable organization, does the average value of your property that is not used for charitable activities or administration exceed $100,000? This could include real estate, investments, cash and bank accounts, inventory, stocks, bonds, mutual funds, GICs, land, and buildings. Note that this is calculated during the 24 months before the beginning of the fiscal year. If it's below that amount, the DQ does not apply. If yes, if it's above that amount, the DQ does apply. And in order to calculate your DQ, you need to multiply the average value by these graduated rates. 3.5% for amounts up to and including $1 million, and 5% for amounts above $1 million. You would follow the same train of thought for public or private foundations, except the average value of property threshold is $25,000. Just for context, note that this graduated rate is new and applies for fiscal periods beginning on or after January 1st, 2023. This change was announced in the 2022 federal budget. Previously, the rate was a flat 3.5%. If this seems complex, don't worry, we'll look at how you filled this out in your annual return, Form T3010, later on in the presentation. All right, so how do we go about calculating a charity's DQ? Here's a broad overview, and then we'll go into specifics for each step on the slides that follow. Step 1, identify the charity's property that is not used for charitable activities or administration. Step 2, determine the valuation periods. Step 3, calculate the average value of the property. And step 4, multiply the average value of the property by the DQ rate. On the right-hand side of the slide, we will work through an example using Live Life Wild, a fictitious charitable organization that helps protect endangered animals. So, step 1, identify the charity's property that is not used for charitable activities or administration. So, like we determined earlier, this could include cash in bank accounts, stocks, land, buildings, etc. Note that if a portion of a charity's building is being used for non-charitable activities, then that portion should be prorated, that is, adjusted to reflect the actual amount used, and then that amount should be included in the calculation. Here are some questions that you could ask yourself to determine whether property is or is not being used for charitable activities or administration. Purpose of use. Was the property used directly to carry out the charity's mission or charitable programs? Was the property used for administrative tasks necessary to support the charity's operations? Nature of activities. Are the activities conducted on the property directly related to the charity's purposes? Are the activities necessary for the management and operation of the charity? So in this instance, Live Life Wild has identified its property as one building and one share. Step 2, determine the valuation periods. But what are valuation periods? They are specific time frames over which charities calculate the average value of their property. The charity needs to divide a 24-month period of time into anywhere between 2 and 8 equal consecutive periods. At the end of each of these periods, it needs to determine the value of its property. The charity chooses its valuation period when it files its first information return. And once chosen, the charity must get the CRA's written permission to change it. The valuation periods are different depending on if we're trying to find the DQ for the current fiscal, which is the amount on line 5900 of the T3010, the average value of property for the 24 months before the beginning of the fiscal period, or the DQ for next fiscal, which is the amount on line 5910 of the T3010, the average value of property for the 24 months before the end of the fiscal period. In this example, the charity's fiscal period begins on January 1st, 2023, and its fiscal period ends on December 31st, 2023. It assesses the value of its property twice a year, in June and December. So this means that it divides 24 months into 4 valuation periods. So if we want to calculate the average value of the property for the current fiscal, for line 5900, we need to use the 4 valuation periods before the beginning of the fiscal period, before January 1st, 2023. June 2021, December 2021, June 2022, and December 2022. And if we want to calculate the average value of the property for the next fiscal, for line 5910, we need to use the 4 valuation periods before the end of the fiscal period, before December 31st, 2023. June 2022, December 2022, June 2023, and December 2023. As we continue on to the next few slides, we'll proceed with calculating the DQ for the current fiscal. So we've determined that there are 4 valuation periods, and they are between June 2021 and December 2022. Step 3, calculate the average value of the property. We begin with 3A, identify the fair market value of the property following each valuation period in the last 24 months. As per the valuation periods we determined in the last slide, column A shows that there are 4 valuation periods, and column B shows the dates of the valuation periods. We then move on to column C, which shows the value of the building following each valuation period, and column D, which shows the value of the share following each valuation period. We add the values in column C and column D to get the combined value in column E. 3B. Now we add the combined values in column E together and divide by the total number of periods, which is 4, that equals $610,000. The charity writes $610,000 on line 5900 of their tax return. Lastly, 3C. We determine whether the average value of the property is over $25,000 for public or private foundations or $100,000 for charitable organizations. Because the average value for their property is over $100,000, they must also complete Schedule 8 within the T3010, and they would also have to include the average value on line 805. You'll see when you're filling out Form T3010 that question C17 will prompt you to make this determination. If the average value of the property is less than $25,000 or $100,000, then the DQ does not apply. In this example, Live Life Wild is a charitable organization, and the average value of their property is $610,000, which is over $100,000, which means that they must proceed with calculating and meeting their DQ. They will click Yes to question C17 and be automatically prompted to fill out Schedule 8 of the T3010. Note that some charities who are still filing on paper are completing Schedule 8 simply because it is part of the form, without checking if it applies to them or they meet the threshold. It's very important to take the time to do this calculation properly to be able to report on it properly. This is one of the main benefits of filing online. You only have to fill out what is necessary, and you reduce the risk of making errors. Step 4, multiply the average value of the property by 3.5% for property up to and including $1 million, and 5% for property exceeding $1 million. So the average value of the property in our example is $610,000. Since that is below $1 million, we multiply it by 3.5%. That gives us $21,350. So that would be the disbursement quota. And you would add this amount to line 820 and 840 in Schedule 8. Here's how we would present these amounts in the T3010, just to help you visualize these concepts a bit better. Our average value of property would go on line 805 and 815. Whether you are filling it out online or on paper, it has to appear in both spots. Then the average value would be multiplied by 3.5%, and the total, the DQ amount, would be added to lines 820 and then be automatically added to line 840. You can always use our guide T4033 to walk you through filling out each of these lines if you are unsure. Here's another example. Meet We Love the Earth, a fictitious private foundation that was registered as of January 1st, 2022. To calculate their DQ for the December 31st, 2023 fiscal period ending, we start by determining the property that is not used directly for charitable activities or administration. On February 22nd, 2022, it received a gift of securities valued at $500,000. Now to find the average value of the property. Since we are looking at the 2023 fiscal period, we need to find the value of the property from 2021 and 2022. That is the 24 months before 2023. The charity checks the value of this property every 12 months. So that means that there are 2 valuation periods within 2 years. To find the average value of the charity's property, we add the combined value of their property from the past 2 valuation periods and then divide that by 2. $0 plus $500,000 divided by 2 equals $250,000. Based on that, the charity writes $250,000 on line 5900 in Schedule 6 of their information return. Since the charity is a private foundation and the average value is over $225,000, then they must proceed with calculating and meeting their DQ. So they would have answered yes to question C17. And since they wrote $250,000 on line 5900 of Schedule 6, line 805 of Schedule 8 will automatically be populated as well. Now, we multiply the average value of the property by 3.5% because the average value is below $1 million. So $250,000 times 3.5% equals $8,750. This means that We Love the Earth's disbursement quota for 2023 is $8,750. And you would put this amount on line 820, and it will automatically populate for line 840 in Schedule 8. Always double check these numbers are appearing in both spots. One last example. Meet Feed the World, a fictitious charitable organization that has been registered for 10 years. Again, our goal is to calculate their DQ for the December 31st, 2023 fiscal period ending. But in this example, we already have the average value of their property from the past two fiscal periods, $1,500,000. So the charity would write $1,500,000 on line 5900 of their information return. Since Feed the World is a charitable organization and the average value is over $100,000, then they must proceed with calculating and meeting their DQ. So they would also write $1,500,000 on line 805 of Schedule 8. In our other two examples, the average value of the property was under $1 million, so we multiplied them by 3.5%. But in this example, the average value of the property is over $1 million. So we need to multiply the first $1 million by 3.5%, multiply the amount over $1 million, $500,000, by 5%, and then add these two numbers together. So $1 million times 3.5% equals $35,000. $500,000 times 5% equals $25,000. 35,000 plus 25,000 equals 60,000. That means that Feed the World's disbursement quota for 2023 is $60,000. Since the average value is over $1 million, they would need to complete lines 825, 830, and 835 of Schedule 8 rather than 820. This will populate the DQ amount on line 840. And again, here is how we would present these amounts in the T3010. Our average value of property would go on line 805 and 815. In order to do the calculation correctly, you would take line 815 minus $1 million and add that amount to line 825. Then multiply line 825 by 5% and add that amount to line 830. Then take line 830 and add $35,000, which is $1 million multiplied by 3.5%, and add the total, the DQ amount, to lines 835. This number will also go into line 840, which is on the next page in Schedule 8 of the online return. All right, now on to a few considerations. First up, accumulation of property. Accumulation of property happened when a registered charity received written approval from the Charities Directorate to set aside funds for a major future expenditure. So, for example, a charity dedicated to providing shelter for unhoused individuals might have requested to accumulate property if it planned to purchase a new building but needed several years to raise the necessary funds. Or a medical research charity might have requested to accumulate property so that they could save up to buy specialized equipment, which would have been an investment that required significant funding. Before January 1st, 2023, charities could request this option, which would allow them to exclude accumulated property from their DQ. As of January 1st, 2023, this is no longer an option. If a charity received approval to accumulate property before January 2023, the approval is still valid under the terms indicated until the approved period expires. Note that we will not grant extensions. Excesses and shortfalls. If a charity spends more on its charitable activities or qualifying disbursements than its DQ for the year, this is referred to as a disbursement excess. Disbursement excesses can be carried forward for 5 years that immediately follow the excess tax year, or carried back the 1 year that immediately preceded the excess tax year. If a charity spends less on its charitable activities or qualifying disbursements than its DQ for the year, this is referred to as a disbursement shortfall. A registered charity can draw on disbursement excesses from the 5 previous fiscal periods to help it meet a shortfall. If no excesses are available to draw on, the charity can try to spend enough the following year to create an excess that it can carry back to cover the shortfall. But how does a charity know if it has an excess or a shortfall? Or in other words, how can a charity confirm if it's met its DQ? To do this, it needs to calculate its expenditures. Begin by identifying the expenditures on charitable activities, line 5,000. You then add the qualifying disbursements, which include gifts to qualified donees, line 5050, grants to non-qualified donees, line 5045, and then subtract any designated gifts. I'll explain designated gifts in the next few slides. You will need to include these calculations in Schedule 8 on lines 845 to 860. Here's how we would present these amounts in the T3010. In Schedule 8, we have the DQ amount on line 840 in red, the expenditures on lines 845, 850, and 855 in yellow. Note that these are copies of the amounts on lines 5,000, 5045, and 5050. The total of those 3 lines on line 860 in purple. You are prompted to minus line 840, your DQ in red, from line 860, your total expenditures in purple, and write the total on line 865 in green. Line 865 is your charity's DQ excess or shortfall. Once you have calculated the expenditures, you compare this number with the DQ. If the expenditures equal or exceed the DQ, then that means that a charity has met its DQ. If the expenditures are less than the DQ, then that means that a charity has not met its DQ. If a charity can't meet its DQ due to reasons beyond its control, it can send the CRA a request to reduce its DQ by a specific amount for a specific fiscal period. But the charity must first do everything it can to cover the shortfall, including the options we went over in that previous slide. This means the charity has to look at the previous 5 years to see if it has any excesses to draw from. If it still has a shortfall, then it should try to spend more the next year. If the charity proceeds with asking for a reduction, and if the CRA approves the request, the charity then has to update its T3010 information return for that year and report the approved reduction on line 5750. To update its return, the charity has to complete Form T1240, Registered Charity Adjustment Request. You should note that any requests for DQ reduction can be made available to the public upon request. Before we move on to other considerations, we wanted to note that when filling out Schedule 8, you will also have to estimate the DQ requirement for the next fiscal period. As with other sections of the T3010 online, line 870 will generate automatically from line 5910 of your return, and the instructions will walk you through the remaining steps. It's really important here that if you entered an amount in line 5910, you fill out this portion. Another important consideration, the anti-avoidance rule and designated gifts. What is the anti-avoidance rule? If a charity receives a gift from another charity that is not at arm's length, that they are related to, they must spend 100% of the fair market value of the gift on either its own charitable activities, gifts to qualified donees that are at arm's length, grants to non-qualified donees that meet the requirements of the Income Tax Act. The charity cannot gift it to another charity that is not at arm's length, to another charity that they are related to. Why does this rule exist? Without this rule, there is a risk that charities that are related would be able to transfer money back and forth while reporting the gifting as spending and without actually making any charitable expenditures. The image here shows how Charity A could gift $1 million to Charity B, then Charity B could gift the same amount to Charity C, and Charity C completes the loop by gifting this amount right back to Charity A. While each charity is technically gifting the money and everything seems compliant on paper, none of it is being used for charitable work. The anti-avoidance rule prevents this from happening. A designated gift is a type of gift made between registered charities that are not at arm's length, that are related. So, a donor charity gives a gift to a non-arm's length charity, identifies the gift as a designated gift, and then cannot count this gift as a qualifying disbursement. The charity must therefore make other qualifying disbursements. It must spend some of its other money on charitable activities in order to meet its DQ. On the flip side, a recipient charity receives a designated gift from a non-arm's length charity, and then it either does not spend it, in which case it becomes its property and is included in its DQ calculation, or does spend it, in which case it is not included in its DQ calculation. Another way of looking at this, the amount of the gift must be spent on charitable activities and/or qualifying disbursements by either the donor charity or the recipient charity. So if the donor charity chooses to designate a gift of $100,000 and the donor charity has a DQ of $300,000, the donor charity must spend $400,000. It's $300,000 DQ plus the $100,000 gift to equal $400,000 on its own charitable activities and/or qualifying disbursements. On the flip side, if a donor charity does not indicate that the gift of $100,000 is designated, and the recipient charity has a DQ of $500,000, the recipient charity must now spend $600,000. It's $500,000 DQ plus the $100,000 gift to equal $600,000 on its own charitable activities and/or qualifying disbursements. Failing to meet the DQ can have serious consequences and lead to compliance actions. There could be financial penalties if a charity receives gifts, other than designated gifts, from a related charity and does not spend them on the charity's own charitable activities or on making qualifying disbursements through gifts to qualified donees or grants to grantee organizations. For example, to meet its disbursement quota requirements, a charity that received gifts from related charities cannot include the value of those gifts in their expenditures when calculating their disbursement quota. For example, if a charity received $100,000 from a related charity and has a disbursement quota of $300,000, it must spend $400,000. $300,000 plus $100,000 equals $400,000 on charitable activities, not just $300,000 to meet its disbursement quota. The penalty would equal 110% of the amount not expended or gifted for the recipient charity. Revocation of charitable status. If a charity consistently fails to meet its DQ and does not correct its spending practices, we may revoke its charitable status. Now, we'll go over a few common errors we see in the T3010. If you've been following along, you won't be making these errors. First, it may seem a bit obvious given everything we've been through today, but some charities are filling out Schedule 8 even though they should not. Question C17 is very important, and you should only fill out Schedule 8 if you said yes. As we mentioned, if you use the online form, that won't be a problem. If you're filling out Schedule 8, both lines 805 and 815 must be completed, not only one of them. You should also check the math for line 865. The amount will be positive when there is a DQ excess and negative when there is a DQ shortfall. Next, many charities leave line 5900, property not used in charitable activities or administration, blank. But they also report amounts on line 4140, long-term investments. Long-term investments are considered property not used in charitable activities or administration. So that means that these charities are not completing line 5900 properly because they're reporting that they don't have property not used in charitable activities or administration when in fact they do. And lastly, we also see many charities enter information on line 810 even if permission to accumulate property has not been granted. Only charities that have been granted this permission should fill out line 810. So that just about wraps up our presentation. I do have some DQ related provisions here that you can keep handy for your reference if you're looking for exact wording from the Income Tax Act. Otherwise, thank you so much for attending today's webinar. We hope we were able to answer your questions. Here is the number to reach our client service representatives dedicated for charities, 1-800-267-2384. There you can speak directly to one of our representatives. They're available to help you Monday through Friday from 8 a.m. to 5 p.m. Eastern Time. We will be sending you a link to an online survey about today's webinar. Please take a few minutes to complete the survey. Your feedback is really important to us. It helps us evaluate the effectiveness of our webinars and plan for our future outreach activities. If you would like to receive recent news and updates from the CRA, we recommend you sign up for our electronic mailing list at canada.ca/charities what's new. And if you haven't already, make sure you sign up for a CRA account so that you can file your annual information return online. Thank you.